All right, thank you, Umami Finance Team, and welcome to another edition of DeFi Dojo's Community Call. So today we're joined by Ox Prepop, DeFi Alpha, and Carnation, three of the you guys call yourself chefs, uh, builders for the Umami Finance Team. So why don't you guys introduce yourselves individually and then tell us what Umami Finance is?
Sure. I guess I'll introduce myself briefly, talk a little bit about Umami, and then pass the mic to Prepop and Carney. So I'm effectively, as you mentioned, we call ourselves the executive chefs. I've sort of played project lead slash sort of strategy lead role for Umami for quite some time now. I joined early in Umami's life cycle back in October, and then took over sort of leading the project in late January, early February, at which point we really undertook a pretty transformative strategic pivot that kind of took us to the stage that we are now with some of the products that we're going to talk about. But to sort of give just a very high level overview of Umami, so we, as many folks in the community might know, we originated as an Ohm fork, kind of at the peak of Ohm fork frenzy. We had all the kind of hallmark Ohm fork tokenomics. Sorry,
It's
did you
like
have
I'm
a
doing
hello?
like all the spare time, like when I'm doing technically doing nothing.
I'm going to go ahead and mute him as well. All right, there we go.
Okay. I'm just going to continue with what I was saying. So Umami originated as an Ohm fork. We had, the sort of classic, very high emissions driven APY. I think at one point we had touted back in September, million plus APY. That was about when I was maybe first joining or first sort of getting to know the people in the project. Anyways, as most of you guys know, Ohm, Olympus DAO, and the other forks, they all kind of flamed out, largely because of unsustainable tokenomics. And I had the opportunity to kind of take over the project. There was pretty much a full rollover in the team at Umami and the leadership, and there was a great opportunity to reassess our position in the Arbitrum ecosystem, and look at the protocol owned liquidity that we had raised from sort of the Ohm fork bonding era, and ask what can we do to really generate sustainable value. And so, to that end, I think some of the things we'll probably chat about today are that, first of all, we have a zero emissions tokenomics model. We have a max supply of 1 million Umami. There are no incentive emissions at all. Umami generates value because it can be staked for passive income in ETH taken from our protocol revenue. So 50% of all protocol revenue is passed on as ETH, dividend-like payments to our stakers. And our protocol revenue comes from a growing roster of vaults, which we will talk about in more detail soon. But the kind of core vault strategy that we're going to be launching in really less than 2 weeks is a delta neutral vault for USDC deposits. It pays yield of targeting 25 to 30% plus APR in USDC to depositors, and it leverages the GMX platform, which is a really incredible blue chip project on Arbitrum. And we can talk a little bit more about sort of how that works and how that delta neutral position is achieved. But that's one of what's going to be really many vaults launching for the second half of this year that we're very excited about. And I will cut it off there and pass the mic to Prepop and Carnation.
Sure. So yeah, this is Prepop. So just to give a general introduction, I'm kind of got started in crypto like way back in the mining days for like the script miners on video cards like in 2014 and that sort of thing, and built a serious interest in decentralized currency and set up mining pools, and then eventually Ethereum launched with smart contracts, and got very interested in that, and doing some got into Mev and a lot of really fun stuff. And I was actually for a long time just a holder of Z2O as it was, and eventually Umami, and was always drawn to the community, just some great guys, always involved. And, there was a point during their transition that I was listening to DeFi talk on the AMAs and explaining kind of the strategies and their plan forward. And, it really clicked to me. And I thought, I'm on, I'm a part of a community for Umami for a reason. I'm very bullish on all of the projects on Arbitrum and Arbitrum itself, and I just felt really aligned with the strategies and plans that Umami had set out. So I reached out and did some, technical advising for a while, and then eventually, just had the opportunity to, make a switch from my full time job, which was, at a defense tech startup, and I had the opportunity to kind of transition to working in DeFi full time, which has been a dream of mine for a while. And so I joined on as executive chef for the tech side, and it's fantastic. It's a dream every day to work on DeFi stuff, and there's certainly no shortage of work with Umami. We have a lot of really cool things planned, a lot of ambitious things planned, and yeah, I'm sure we're going to be covering a lot of that here on the AMA. So, Carney, do you want to give an introduction?
Yeah, hi everyone. This is Carney. So I've joined Umami back in February, and I was also a 02 holder. By that time, my bag in this was very small. So when I joined, I was tasked with mostly finding yield opportunities to manage the treasury to make sure, like whatever market that happens afterwards, we will be able to preserve capital and maybe build something interesting. And one of the things we stumbled upon, sort of just haphazardly, was that we had already a large position in GLP on the GMX platform, and then we were just basically thinking, oh, this is like a pretty neat yield position, and it's like, okay, well, like how do we maybe optimize it a little, like hedge our risks a little, and that sort of led to one of these major vault products that we're developing now. And I think we might speak to more details later. So yeah, I'll just stop here.
Okay. Well, thank you all for the introductions. That is very interesting. I do remember when you guys were, Z2 Ohm and originally an Ohm fork, and I thought it was interesting that you went with like sort of the anime motif. But now you've done a complete rehaul of your. So sorry, they're I guess apparently doing construction today or something directly behind me. Hopefully that will stop soon. But you guys did a complete rehaul of your user interface, which was great. But what we're here for is that delta neutral vault, certainly, and then all of the other interesting vaults that you may be coming up with soon. So I know GLP. I think most people who are listening probably know GLP as this index token that you can stake for escrowed GMX and I guess ETH or wrapped ETH on Arbitrum or AVAX or WaveX on Avalanche. How are you guys making this delta neutral, and can you explain how it's delta neutral and not pseudo delta neutral, given your mechanism?
Sure. Maybe I'll cover it at a high level, and then I'll pass it on to Carney and Prepop, who can also really help delve into the mechanics of it. But as you said, GLP is a really interesting asset unto itself, and for those who are not familiar, it's essentially owning GLP means that you have a claim on the liquidity pool that provides liquidity to the GMX trading platform. And in exchange for providing that liquidity, you get a claim on the platform fees, as well as any net gains to GMX from effectively having a counterparty position in some of these leverage trades that people do on their platform, and GMX tends to come out ahead of traders pretty consistently, and so that those fees and the sort of net favorable P&L to GMX get passed on to GLP holders in the form of ETH, and it can also be wrapped ETH to your point, Stephen. And then, of course, there's also escrow GMX incentives as well, and those are interesting. You might come back to this later because the longer that they are staked, the more they accumulate multiplier points, and these multiplier points, basically, the ESGMX also has a claim on some of the ETH fees from the GMX platform, and the more multiplier points you have, the larger your cut of fees are. So those are sort of two ETH generating tokens, right there that can form sort of the basis of the yield on this vault. And then there's the question of delta neutrality. And so for those who are not familiar with Arbitrum, there's a really incredible and I think somewhat underappreciated project on Arbitrum called Tracer DAO. And Tracer has these very innovative. This is this innovative platform for creating a new type of financial or a new type of derivative that allows for taking leveraged hedging positions relative to tokens like Bitcoin or ETH that don't liquidate, and that's because they use what's called a perpetual pool, which is you don't actually have to have a levered position in the underlying token to track that performance. And so what we've been able to do essentially is if you look at GLP, it's 50% stable coins in that pool, and then the majority of the remaining assets are Bitcoin and ETH for the most part, a small amount of Chainlink and Uniswap, but insignificant. And we can pretty much fully neutralize that delta by maintaining equivalent hedging positions through the 3S ETH and 3S BTC, so 3x levered short hedging tokens from Tracer DAO. And the way that this vault is structured, it has very frequent epochs during which it rebalances as needed to maintain that position. There's also some other interesting features to its mechanics that provide further protections in the case of sort of a sudden market drawdown, so that we can say that it's sort of a true delta neutral vault strategy. And the upshot of all of this is that through this kind of elaborate engineering, we have a vault that can generate. It accepts USDC as its deposit token. It generates APR between the incentive yield on the tracer hedges and, of course, the yield on GLP of 25 to 30% plus. And I guess the last little note that I will make, and then I'm very keen to have Carney and Prepop chime in as well, is that we use the ERC 4626 standard, meaning that this vault is tokenized. There's a fully tradable fungible token you get when you deposit into it, which creates all kinds of utility. You can lever it. We're working on a partner so that people can choose to add some leverage to it if they want. You can trade it if you want quick liquidity without needing to withdraw your underlying assets. So, and if you do choose to withdraw your deposit, you get that APR in USDC. So it's USDC in and more USDC out. So we're really excited because we think it's a very appealing overall structure for retail investors, whales, and also we have interest from institutional capital and protocol treasuries. We have a couple of protocol treasuries that have already expressed interest or invested with us. So that's kind of the general overview, and happy to answer any questions you have. And again, Carney and Prepop can also offer some great insights.
So I do have a bunch of questions, but if there's anything that Carney or Prepop want to add first, I'll let them do that.
Yeah, maybe I'll just talk very briefly about the thing about pseudo delta neutrality versus true delta neutrality. So true delta neutrality means that no matter which way the price of the underlying asset moves, your value of your position never changes. And this is actually extremely, extremely rare in the markets because what you usually do to get very close is to, for example, run a strategy that's called cash and carry or the basis trade, where you hold a token in spot and then you short it on the futures. And typically, on average, over very long times, the funding rate is the longs pay the shorts. So even then, while your overall position doesn't move, no matter which way your underlying moves, your position actually increases over time because your constantly receiving this little bit of funding fees. And a different way to do this that's called pseudo neutral leveraged farming usually is when you take a farm position and you borrow both assets to LP. And if one of these assets is volatile, you get into this situation where as long as the assets remain in a tight range, you will be profitable. But once either the volatile asset goes up too high or too little, what happens is you incur a lot of impermanent loss. And if that loss is higher than the debt you took on to create this position, what you end up with is you get liquidated. So with pseudo delta neutral leverage yield farming positions, it's a mouthful, that's the risk you're taking. So a difference that we're doing here is I guess you can consider this a little bit in between. So one of the key features of our strategy is that it is non-liquidatable on either side, because with the GLP token, you cannot be liquidated. And with Tracer's leveraged shorts, they're power perpetuals. It's slightly different from linear perpetuals that you get on a centralized futures exchange. But essentially, the key plus there is that the Tracer longs and shorts, they do not get liquidated. But they do suffer from what's called volatility decay, which is just a mechanism of its rebalancing, but you are compensated with TCR token emissions. So yeah, what is true though is that if the price of the assets inside GLP are moving rapidly up or rapidly down, the hedges are not sorry, if the prices move significantly before the epoch of the rebalancing ends, you do get a tiny bit of impermanent loss. But this is how we're currently thinking of it. If the assets inside GLP, especially the Bitcoin and ETH, which is like most of the volatile assets, if they tend to drop, then you can think of the GLP sort of as a LP position between stablecoins and Bitcoin, or stablecoins and ETH. So our hedges are actually no impermanent loss. They just go, they're pretty much 100% short in short time frames, and your LP position is like half a long. So on the downside, you will actually make money, and so on the upside, if Bitcoin and ETH rapidly increase in very short time frames, we probably do lose a little more on the shorts. But on the plus side, the rewards you're earning are actually in ETH. So, like net everything, like these two key assets, Bitcoin and ETH, are very, very stable relative to anything else in these markets. So like we do not expect a huge amount of volatility. But the main point I just wanted to stress here is that the key to maintaining good stablecoin or relatively stable or delta neutral positions is just protecting your downside. And in the event that Bitcoin and ETH does this like straight nosedive, our position will actually earn. So like it's not impermanent loss; it's actually a little bit of impermanent gain in some sense. Yeah, and I'll let Prepop talk a little more about the other details.
Sure. Yeah, I can go into a little bit detail of the process of how we achieve this. So the vault runs as we've mentioned on rolling epochs for our rebalancing. Part of that is to adjust for market conditions. So we have basically a model that we're using that will take in recent and predictive volatility of the volatile assets that we have, and we're able to basically take all of the assets that we have currently for inflows, outflows, changes in all underlying asset prices, and throw that into a model to compute the maximum yield with accounting for a minimum amount of drawdown for our hedges. And we can use Monte Carlo simulations, and it is one of the top things we use, and some other analysis to just verify the performance in every condition, right, of extreme drawdowns and things, and to also try to maximize the yield based on all the components, a balance between hedges and GLP and different yields between both of those that we're getting. So as the epoch rolls over, we run the models, get our optimal balancing and hedging for that epoch period, which is still to be determined, but probably within like 8 hours to a day is somewhere in that range that we're looking at for epoch timing, and we'll rebalance as needed.
All right, excellent. Thank you guys so much.
So
for
yeah, if you have any
yeah.
any questions on any specific parts of this, more than happy to take some questions now.
Thank you for the 3-part explanation. So yeah, there are a few questions. One of them we already have in the chat, which is great. Cool that you guys are utilizing the chat. By the way, if anyone has questions, please do put them in the chat. That'll make it easy for us.
Steven, is your microphone having an issue?
Yes, I guess.
I think Steven's microphone's having a little bit of an issue there. So I'll that out.
Okay, I'm back.
And maybe
Sorry about that.
he's
Mara,
back. Right?
thank you for taking over for a second. My mic sometimes cuts out in this location. It's either here or my house where I'm gonna have screaming children, so this is generally better. Thank you for if there's a silence, it's usually me. So just let me know that I'm quiet and I'll disconnect and rejoin. For some reason that fixes the problem. Don't know why. Darn this place. Anyways, lots of questions. If you have more questions, please put them in the chat. That's a great place to ask questions right now. We'll get to those ones towards the end. My questions are hopefully we can get through them pretty quickly. One of them is you guys are utilizing Arbitrum as your chain, so there is some bit of uni and link exposure. How do you account for those which are going to have a larger drawdown, presumably than BTC and ETH in bearish conditions?
Hey, do you want to take this one, or you want me to handle it?
I think you can go either way, and Carney, feel free to share your thoughts. I mean, so if the uni and link exposure is really mild within GLP. It's about 1% of the overall allocation, and again, obviously, it's worth noting that they are quite correlated with BTC and ETH, and so by hedging out those two, we are covering a good amount of the the likely movements for Uniswap and Link, and again for a very small portion of the portfolio.
Oh wow! Yeah.
So that being said, though,
it's roughly
remember that we are not relying exclusively on the tracer hedges in order to maintain this delta neutral position. So we have a couple of other stopgaps in place, because that's not. And maybe this is another question you were thinking of asking us, but that the risk of some kind of sharp drawdown in perhaps Link or Uniswap or just any sort of uncorrelated movement by those two tokens is just one of the ways that there could potentially be something that pulled us away from tracking perfect delta neutrality. The other potentially bigger risk is simply that at the beginning of every epoch that Prepop described, we do position this vault to be truly delta neutral. And over the course of that epoch, there's a chance that it drifts slightly from that just overall. And if there were a very sharp drawdown during that point in time, there could be some effect on the underlying asset value in the vault, which is obviously not what we want. And so,
but that second case is modeled out, right? So we have like a maximum sigma that, in a case of the most extreme conditions, our model has a cap of maximum drawdown, and it's very, very little.
It's very little. What do we settle for, Bob? It's less than 5%, correct?
Mm-hmm. Yeah. Mm-hmm.
Yeah.
And
so I guess go ahead. Sorry, I'll let you.
I was just going to say, so we do have in the modeling, we do have Chainlink and Uniswap, and so the conditions that we're talking about, because we're able to account for some correlation in those asset prices, but in the case that like just Link blows up, right? Like Chainlink has a problem, and everybody exits Chainlink, and maybe it doesn't affect Ethereum or Bitcoin. So I think with that case, we don't have a short on those particular. We have the shorts that handle um, the overall GLP assets, accounting for that, like you was saying, like 1.5% of the GLP index. But I think if that was the case, the extreme, one of those being extreme is one of the risk of to drift slightly off delta neutrality, like DeFi was saying.
Yeah.
Um,
But we should talk a little bit about the parameter that allows us to build up a buffer, correct?
yes, yep,
Repop?
exactly,
Yeah,
yep.
that's what I was going to bring up. But why don't you explain it? You'll probably do it more elegantly than me since you've really helped design the vault.
So yeah, so in essence, the plan is to build up a buffer to handle for those, with a lot of the yield coming, and the things like the stake GMX being added to over time. And so one of the things that we don't do is we don't account for the like the escrow GMX in part of the yield calculations, because they're used for like building a multiplier over time and increasing the wrapped ETH over time. And so it's effectively accounting for a buffer of in the event of anything dropping down, we have that ability to pad out some drawdowns from events like chain or blowing up, Chainlink blowing up, or Uniswap. So.
Yeah, I mean, I think the only thing that I would add to that, just to kind of really reiterate some of the points that Prepop made. So the model that we have built, we were partnered with a group called OT Balance. They built a Monte Carlo analysis for us that is what we use to determine, our allocation between GLP and tracer hedges at the beginning of each epoch. And that, we make sure when we do that, the way that we structure this model is that, we want to make sure that we are never positioned so that even in the most extreme drawdown, in Monte Carlo analysis, we run many different scenarios, including highly unlikely scenarios. Even the most extreme drawdown, no more than a 5% movement in the underlying deposited assets in the vault. Now we don't even want to accept a 5% potential drawdown for the deposited assets. And therefore, what we do is when we first launch this vault, we're going to provide some of our own protocol and liquidity, which is already heavily invested in GLP and Tracer hedges into the vault to provide permanent seed capital that we are willing, if there were to be some kind of, essentially run on the bank type of liquidity crunch during a drawdown, that could be drawn on to cover that, maximum 5% exposure. And then as the vault's TVL scales, we have, as Prepop said, kind of two levers. And one is a parameter that lets us take some of that ETH from the accumulated ESGMX, so the ETH yield on that, and build up more of a buffer for the vault. And finally, the ESGMX is gradually vested into GMX over a 12-month period, which means that over time we build up liquid GMX that we very much would prefer to keep staked, because the longer it's staked, the more multiplier points it develops or accumulates. But if that's just more of potential asset buffer. So I think the aggregate effect of all this, plus the fact that the vault will be insured, means that we actually are very confident that this can be, true delta neutral in the way that Carney described, and not expose depositors to any kind of material risk to the deposited assets, even in a sharp market drawdown.
Okay, so awesome, thank you. I didn't know how small the exposure to Uni and Link was until I just looked, and it's roughly a little bit less than 2%, like 1.8%. So that already dismissed the majority of my concerns there. Thank you for the eloquent response. One of the other questions I have regarding the delta neutrality is that because you're using the shorts from Tracer DAO, and I believe they work similar to the ETF shorts on KuCoin. they have a rebalancing mechanism. And that rebalancing can sometimes experience something similar to impermanent loss. Is there a way that you guys are accounting for that as well?
Yeah, I can take this one. So, yes, it's absolutely right. All levered ETFs in the market, well, all that I know of, use a similar mechanism. And essentially, how they achieve leverage is they buy high and sell low. So, like after repeated volatility, even if you're ranging, this method is the surefire way to lose value on your positions. So Tracer, they also know about this using their own platform. So what they're doing is with their V2 product, which is now live, they take a longer time period where they do this rebalancing so that they're not excessively buying and selling out all the time or just rebalancing all the time, which drastically lowers the amount of impermanent loss there is. So these are like very rough guidelines, but like for their V1 position, like they're of course like non-financial advice, but it's to hold these, maybe on the order of a few weeks to a month, and then check your positions for any significant drifts. And for their V2 product, they expect them to be quite stable over the course of a dozen weeks to several months. So that's what we're really excited to keep working with, because they're finding new ways to improve the features of the product so that we have less to worry about on that side.
Excellent. Oh, I think, let me leave and join again. Okay,
Yeah,
go ahead.
I was just going to say, I think Carney put it very well. We've timed this vault to the launch of the V2 pools with Tracer. In fact, we built it around those pools, so we're much less concerned about what they call volatility decay, which is their equivalent of impermanent loss, than we would be were we using the V1.
Excellent, love it. And I do believe they also, if they do experience volatility decay, they, as you said earlier, give some sort of reward in their proprietary asset. One of my questions, I know that I'm asking questions that seem like I'm trying to pick at you, but really I'm just curious, and I really do like this project. One of the questions that I have is, with the GMX mechanism, when you said that you may end up with a large amount of vested or liquid GMX. Now maybe I'm just misunderstanding how the protocol works, but when you start vesting your GMX, doesn't that begin to limit the amount of emissions you get in terms of the ETH from the escrow GMX? Don't you no longer
Not if
realize
you
that?
actually no, and it's a good question because that was something we needed to triple check. Again, it's really sort of an academic point because we have no intention of ever unstaking and liquidating our GMX, and again, we don't think we would ever need to for the reasons that we kind of
Right.
highlighted. But that being said,
But will you be vesting it?
yes, and
Okay.
you can stake it. You can what you can do is you stake ESGMX,
Right.
and then you vest it, and as long as it is staked prior to vesting, you still accumulate
Got
the
it.
multiplier points and all the yields. So it works just fine, and it makes very little difference because we probably won't unstake it anyway.
That's an excellent point. I'm glad that you guys clarified that to me, because I could not find that understanding myself. So thank you.
Yeah, maybe just to clarify with everyone here, so like it is quite a complicated and elaborate tokenomic system they got there. So I guess like the TLDR of it is, when you stake GMX or GLP tokens, you're rewarded with this escrowed GMX, which is ESGMS token, which also gathers you rewards. But they, in order then if you unstake your GMX and GLP, you cannot unvest your ESGMX. So, however your ESGMX was generated, you must keep that original token, whether it's GMX or GLP, staked and press vest. And both of these will be locked over the course of 1 year. So, to many individual users who might, for whatever reason, need to sell out of their GMX and GLP token positions, they'll be left with this ESGMX that's still collecting rewards, but they can never vest it into GMX to sell. But with a vault, we're not going to have these issues, because the vault has like infinite time horizon. It's happy to hang on to the assets ESGMX. It doesn't really care which form it is, but since time horizon isn't an issue, we'll keep vesting them, turn them into GMX in case we ever do need to use them for whatever reason, but we foresee no actual need to. It'll just be to make them as liquid as possible without the intention of spending.
Fantastic. Thank you so much. The next question I have related to the GLP or the GMX platform is we have other semi-similar platforms like Pika, for example, and that may be a crude comparison, but their USDC staking continuously loses value because the leverage traders are winning. And I'm wondering that if we do see a sort of a turn in the competition where the leverage takers on GMX start to, for whatever reason, perform very well, let's say everyone just gets way better at TA overnight, how would that affect the delta neutrality of your vaults?
I think what I can offer, and I'm again curious to hear Carney and Prepop's thoughts as well, but what I can offer there is that I don't believe that it would affect the delta neutrality. It would affect the yield. I mean, unless we're talking about really, really extreme counterparty losses to GLP, I suppose, which would be kind of, the sort of an idiosyncratic loss. I mean, you can't really hedge against that. Now, what we do have in place is, we're in talks with a number of different projects for insurance. And, I think what the ideal insurance structure, again, we have hedges to protect against market risk. So insurance is really about protecting against kind of idiosyncratic risk to GLP, whether it's an exploit or, to your point, some kind of extreme reversal of the trend that we've seen, which is GMX consistently coming out well ahead of traders. And so I think that is where our insurance would kick in to hopefully protect against that.
And one thing I want to add is how GMX operates. They do just the mechanics has a slight hedge that I've noticed for, like, let's say, since there's some leverage trading that skews long on the platform. When someone takes out a long position and you say like an ETH position, you take that ETH position and GMX actually takes your ETH and converts it into USDC. So they actually sell and keep the ETH themselves, right? So when the position goes up, they don't return your position in the Ethereum, the price that you have it. So they're holding on to that Ethereum for the updraw. And so one of the things that does is it helps hedge slightly for those those times. And the other thing I'd like to mention too is like for leverage trading, right? Like leverage trading is a very interesting. It's a very interesting thing, right? And like there is a case of like things go sharply up, but there's also the case of things go sharply up and then immediately back down and then bounce around up and down. And so the percentage chance of like the market just completely being right for all downturns is very small without some leverage trading being wiped out, right? And like there's also the people that win, like how big was their leverage when they did win versus someone's using 50x leverage and then they go, which they're adding, as long as the GLP scales for that, or 30 times leverage, and then just a slight pullback just wipes them out. Just so this is things to keep in mind when talking about like the overall. And so I think the best gauge is historically on GMX and other protocols you can track like the overall P&L and things like that. So I think it's very, very favorable for GMX in my opinion. So.
Yeah, that's what I was going to say, is that the historical data really shows GMX coming out well ahead of traders, and it's worth noting. I mean, GMX kind of has two different fronts on which it can and does usually win, right? And one is that overall, traders do worse than the GMX platform, which plays the counterparty role with most of their bets. And to Prepop's point, part of that is because traders are often playing with so much leverage that even if they are directionally right, the smallest movement in the opposite direction can liquidate them. But also GMX charges pretty significant fees for every trade, and so for GMX to be a net loser, not only would traders have to be overwhelmingly right relative to GMX's counterparty, but they would need to be so correct that it offset the fees to GMX, and the historical data just has shown quite the opposite.
Bit more details to that. So when designing these vaults with our potential partner protocols, it's very important to take a look at exactly what's going on underneath the hood, because like we can just say, oh, we're providing liquidity for a perp dex, and so like that earns some sort of yield. But underneath the hood, GMX does many things with the liquidity you provide them. So one thing is just being the counterparty to all the perp traders. And there, it's like as if we were playing a coin toss game where, we have traders who are betting heads, we have traders who are betting tails, but they don't actually cancel out in that both of them are paying us. We're like the house basically to play this game. So, like all the head betters cancel out with the tail betters, but they're both paying to us. So that's one way we win. Also, when they get liquidated, GMX takes a fee. And also, when they borrow funds to margin trade, they take a fee. GMX also does actually spot trading, and a lot of DEX aggregators now route through GMX for trading on ETH and BTC. So like you can see all this data from the GMX statistics dashboard, which is like stats.gmx.io, I think. And there you'll see that they have at least 4 or 5 different fee sources or revenue sources from how people are utilizing this system. So yeah, like the traders, the lever traders who win against you on any particular day, that's only part of the revenue or loss of the system. But all the other parts, they're up only numbers because they're purely income sources. Yeah.
I'm really feel remiss for not bringing that up myself. I mean, GMX, it's a critical point. I mean, it's one of the reasons that we're bullish on GMX in general, and I think it's going to be one of the key draws of Arbitrum is that GMX is it's known for being this leveraged perp trading platform, but its real value add is that they have the deepest liquidity for certain major trading routes such as USDC ETH or ETH BTC, even deeper liquidity than you would find on mainnet. And they are about to the second half of this year they're going to roll out a platform called X4 that is going to really build on what Carney mentioned, which is the spot trading that they already provide. So to Carney's point, they already have a spot trading platform that takes advantage of this really deep liquidity. Already we're seeing a lot of trades getting routed through it. It's the lowest slippage, deepest liquidity for large block trades in ETH, BTC, USDC. And GMX is going to roll out this X4 platform in the second half of the year that I think will give platforms like Uniswap a run for their money in terms of sort of what they're able to offer with respect to really deep liquidity. I think they've been a little bit quiet on details about X4, but I think that the premise is that it will be sort of an ultra composable version of Uniswap v3 that a lot of projects can kind of build on top of, and that will enable all kinds of different incentives and kind of unique LP structures that the projects can build, or that for their own pairs, or that some projects could build as kind of a farming platform, but with different types of LP strategies. And I'm keen to see ultimately what it looks like, but it's an example of this vault that we're building. It's not just a bet on this perp trading platform. That's what GMX has now. But it's fundamentally a bet on this super deep liquidity and kind of multiple different forms of fee revenue for different types of trading, including more conventional swaps that GMX is going to be building out, for the second half of the year. So that makes us even more confident in, what the return profile for GLP is going to look like.
Thank you. That was a very detailed answer to my question. It also looks like we have a bunch of questions in the chat. So even though I would love to ask more questions, I do want to get to the community questions. I've instructed Mara that if my mic goes out, he can jump in and ask some of these. We'll start from the top with Flowers13, who says, is there a funding limit on the vault? I think this is a question that a lot of people have because you saw vaults like Alpaca, which filled up really quickly. They underperformed, but they quickly filled. So is there a funding limit on the vaults?
Yes. And actually, I'm going to use that as a peg to hit a few just general points about Umami and our strategy. So there is. And why is there? Well, because right now GLP has, last time I checked, maybe about 280 million in TVL in that sort of liquidity pool. And we as I kind of alluded to in what I just said, I mean, we expect the GMX platform to scale and get more volume and attract more liquidity. But based on our math, we're not confident that that GLP will be able to absorb more than 100 million TVL over the next couple of months before that starts to dilute yield. So we're assuming we're going to have kind of the ability to set up rolling caps on liquidity just based on how it affects the GLP return yield profile. But our expectation is 100 million. But what I wanted to kind of hit on a high level with respect to Umami's strategy, and I think people will see more of this in the near future. What I just described is actually the single biggest bottleneck for what we are aspiring to do, which is not just to have cool one-off vault with a 100 million cap, right? We think we're ETH maxis, but we're also Arbitrum maxis. We think Arbitrum is going to be the home of mainnet DeFi. It's going to have, as I said, the deepest liquidity for core blue chip tokens like BTC and ETH. And so we expect to see an enormous inflow of TVL and particularly institutional capital onto Arbitrum. And we think that, the kind of core vault strategies that we're focused on, which would be, this delta neutral kind of high yield in the form of real ETH revenue. And then also we're working on some ETH maxi strategies that have exposure to the upside of ETH. We think that those are going to be huge draws for institutional capital, but to meet that demand, sort of as you pointed out with that question, we need to continue to scout out, new sources of sustainable, real yield based on real protocol revenue. And we need to work to help partners like GMX continue to scale their platform. And we need to, roll up our sleeves and actually build some new functionalities on Arbitrum, which we, have in the works as well, and we'll share more on in the future. But, point being, we are going to have probably 100 million cap on this vault. And what we're going to do over the next 6 months is expect to see a few more similar delta neutral USDC vault strategies launch, maybe with roughly similar caps. Some might be 50 million, some might be 100 million. All of these are going to be tokenized through ERC 4626 standard. And as we roll these out, each one kind of tapping into a different stream of revenue, we're going to eventually be in a position to actually create what we'll call a meta vault, a delta neutral meta vault that will aggregate those, each of the ERC 4626 tokens from the underlying, vaults, and we'll have, overall a much larger TVL capacity, possibly uncapped, that can really handle institutional capital. So that's the infrastructure we're trying to build. But the short answer for this specific vault, there will probably have to be a cap, and we can raise it as GMX continues to scale its own volume.
Okay, thank you. That is interesting to know. Is there anything that an individual investor could do to ensure that they have an early spot, or to better their chances of having an early spot to enter the vault?
Yeah, buy Umami and stake it as Umami or CM Umami because we're going to give our own community first dibs on the vault. So if you are an Umami holder, then you'll be able to be whitelisted for that early period.
Okay, excellent. And has that snapshot already been taken, or because I believe you guys are
Not
releasing
yet.
it the next 2 weeks?
That's alpha. Yeah, we have not taken the snapshots. That is alpha.
Okay, and is there a minimum buy of Umami that would qualify someone for this?
We haven't decided yet. Yes, I don't think it would just be one, but
Right.
we're going to, keep in mind our retail holder
Sure.
community, so it's not going to be ridiculous.
Okay, thank you. Dang, there's so many good questions here and so little time. So a few of the ones that I want to hit on that might be quicker is, can you speak shortly or briefly on the audits of the smart contracts?
Prepop?
Sure, and I would answer. I would say 10 Umami is like a safe bet for waitlist.
Yeah, that's what I was thinking too.
And yeah, for the audit, so the audits are in progress. So we're in communication quite often with auditors at Zokyo, and they're finishing up right now. The stable vault obviously is more complex than some of the other components that we're having them audit, but it was fully comprehensive audit, including all the Umami token itself, the marinate, the auto compounders for marinate, and now the stable vaults here too. And so after their completion of the initial part, usually they reach out to us first with the report saying if there are any issues that were discovered, identified, and the severity, right? Like if they found any critical, high severity, medium, low, minor, and kind of give us a chance to work through and plan a way to handle the issues they found. And we submit, if we do end up making any changes, we submit the code back to them, and then they'll include how we addressed each of the issues that they found. And then we're planning to get that initial report this week or any day now, and kind of dependent on them to get that out to us, but we're definitely in the position where we're ready to respond if we find any issues as quickly as possible, and get that out there, because I think it's critically important to have the audit completed and the final report shared with the community before the launch of the pool. So.
Thank you. Thank you very much. So let's try to hash out a few more of these questions. I'm trying to choose ones that may be time sensitive. One of them is DeFi Alpha. You mentioned that the vault is insured. Can you explain what the insurance means for investors?
Actually, Carney, why don't you take that because you've been researching the different insurance protocols pretty closely, so you're probably going to have the best answer.
Yeah, sure. So most DeFi, so we're talking with several insurance platforms in here, including Insurace, Risk Harbor, Nexus Mutual, Cozy Finance. Like these are all people we're trying to see what we can work together on. And essentially, what comes out of these is the platforms will either agree to spin up a pool to provide protection, and the individual depositors to the vaults have to choose themselves whether they want to opt in to these different uh, insurance providers, and the insurance providers will put a quote on these. So to the depositors of the vault who want to purchase insurance, the typical setup to all these platforms look very similar. Some of them require you to take out the funds from the platforms to deposit into the vaults. That's more Cozy Finance. The other ones are more like you need to um, say how much coverage you want and then deposit your payment to the platforms. And then if something happens, the platforms will pay out to you. If you wanted to know more on like the underneath the hood mechanics of each one of these platforms, you can ask me afterwards because they are quite complicated. But to the purchaser of the coverage, you don't need to worry about those.
Okay, thank you. I think I'm disconnected. Join back in. Okay, you should be able to hear me again, hopefully. Thank you very much. The next one is maybe a little bit of a longer question. We have 5 minutes left. Hopefully, we can get the most out of that. How does Umami determine their short positions? So basically, you're going to have some sort of long exposure based off of the amount of GLP or the amount of USDC, I suppose, staked. How is the short, like, are the shorts all going to be leveraged at 3x, or is it algo determined? Are you going to rebalance? How is that going to work?
So yeah, I touched on this a little bit earlier. It's based on. Can you guys hear me all right?
Yes, absolutely.
Okay, so it's based on the model that we send on the rebalancing. So essentially, every epoch we'll send that to our modeling with the total assets that are currently in the vault, the inflows and outflows accounting for, and we'll want to the idea is maximize the yield while still obtaining the optimal delta neutral positioning on that. So it rebalances. So yeah, it's going to be changing as we need, and it can even change with no asset change. Just market volatility changes, we may rebalance to handle those shifts. So.
Well, one question that sort of stems from that is how liquid will this vault be? So I know that it's going to be sort of tokenized, which is really cool, but due to having epochs and having rebalancing, will there ever be an illiquid period of investment for the investor?
So yeah, and this is a very important point to know for the user or for everybody. But the way the vault works is it is tokenized. So there is a liquidity pool planned to have immediate liquidity on the share claims, on the share tokens. But due to all the limitations of this vault, there is a withdrawal period where you essentially have to wait to the end of the epoch to do a withdrawal. So, and this is similar to how the tracer pool rebalance, and that's part of the reason why we had to do this is to maintain the delta neutrality through the short adjustments. We have to wait for those pool committer epochs to make those finalized adjustments. And so when a user wants to withdraw, if they want it immediately, they can use the liquidity pool to trade. But if they want to actually redeem, there'll be a process where you queue for the next epoch withdrawal through the interface. And as soon as that, and it could be the full duration if it's 8 hours or 24 hours when to be determined. But if you just miss the right epoch, you're gonna have to wait that whole time. But if you're 5 minutes from the epoch, you can queue for withdrawal, and when the epoch hits, the funds will be ready for withdrawal. So yeah, that is a very critical.
Yeah, and that totally makes sense from my perspective. I was sort of hoping that was going to be the answer, was that you would have until the end of the epoch as a lockup, and then after the epoch, then you would have withdrawal. That to me is intuitive. So I guess we'll try to get one more question in the last minute. Thank you guys so much again for answering and taking the time. One of them is, you guys did say in the next 2 weeks is for the launch of the GLP strategy. One question is, was there a back test for the projected APY, and have you also modeled what the APY might be given that a 100 million increase in TVL? Can you hear me?
Yes.
Okay. Okay.
So OT Balance will backtest this vault. They're wrapping up the Monte Carlo analysis that we're working with them on now. And when it's done, we will definitely do a backtest and share that data. And remind me, what was the second part of that question,
The second
Stephen?
question, I guess it's sort of answering the first question, but the second question is, have you modeled what the yield might be given a $100 million increase in TVL for GLP?
Yeah. So and yes, I mean, OT Balance's model will give us really granular feedback on that. But before even sort of proceeding with the vault, when we were thinking about sort of the general TVL cap, I know that Carney did model out just sort of manually what the likely TVL we could add to GLP would be before it started to impact yield, and that was the high end figure. And again, we do assume kind of continued growth for GLP when we think about that.
Okay, guys, I cannot thank you enough for coming on and answering our questions. I think you probably can't even hear me. Let me disconnect really quick. Okay, I don't know if you can hear me, but I wanted to thank you guys again for connecting slowly. Oh, jeez. Okay, hopefully you can hear me now.
No,
Okay,
I can't yet.
thank you. I wanted to thank you guys one more time for coming on and answering all of our questions and giving us a rundown at multiple different layers and levels of your platform and protocol. I do have to go because I have meetings literally right now, but man, thanks again. Very, very excited about this protocol. Very excited to look through the audit reports when those come out. And if anyone has any other questions, I'm sure they can join your Discord. We'll put links all over the place for those. And I look forward to the next few weeks with you guys.
Awesome. Thanks so much for having us, Stephen.
Thank
All
you.
right, thank you.
Absolute pleasure.